So Kunal, I don't know how to read into this. The large caps are taking a pause, but the beaten down names from yesterday, they're making a comeback.
Well, yeah, I think few of them would make a comeback. Like Indiabulls Housing yesterday, the RSI was just, I think, 2 digits, single digit. I think 2 or 3 for the stock on the hourly charts, but that would lead to a maybe a temporary bounce. But I believe that the stock should get sold into. I'm not sure whether the stock is still in the F&O ban or not, but I think that could be another reason why you may see probably a short-lived bounce and then a sell-off into these names. In terms of the opening trade, I would believe TCS could be a stock which I think trusts can keep an eye on. And my sense is that the stock after yesterday's breakout looks very attractive from a short-term play.
All right, let's get in a quick call from Naresh as well as to what he makes of the trade setup this morning. Holding on to the 19,970 mark for the Frontline index. Naresh, the broader markets seeing some sort of a comeback after yesterday's meltdown. Your take?
So we could try to find some footing here on the mid-cap, small-cap indices today. The large-cap indices still are on a promising note only. So large-cap still look interesting. Overall, we'll still play defensive. So that is where I go with Power Grid, which looks like a bounce back, saw a 3% correction, and is one of the few stocks which is setting up for a longer-term breakout going forward.
All right, Vineet Sambre joins us now. Let's connect with Vineet Sambre to understand that what he makes of the current market setup. Vineet, good morning. Good to have you back. Vineet, enough and more has been discussed and debated that where and why mid-cap stocks are up. But after the sharp sell-off yesterday, do you think we are nearing the end of the party for mid and the small cap stocks for an extended period of time? Is the party over? So the Cinderellas of the world be worried now?
Good morning, Nikunj, and I think it is extremely tough to really make out, of these daily moves. And I think the way current, sentiments are around the mid-cap, small-cap stocks, the kind of flows which we are seeing in these categories, I would say that these small corrections will be really bought into, and people may not really give up till the time, there are, let's say, bigger triggers. I mean, there are actually any big negative signs or any big negative triggers which can spiral into a problem as of now. But I'm saying that the world is in a very disorderly state. I mean, we at one end we keep talking about high interest rate, recession fears, and all of that, and at the other end of the spectrum, there is so much money in India which is actually flowing into the small and mid caps for right, wrong reasons that time will tell. I think fundamentally, as the companies which keeps showing strong growth over the long period of time, they will eventually emerge out as winners. And there will be definitely in this rally, there will be spaces which will be, low quality, will be run purely on themes, not backed by numbers. Those will be cause of pain and hurt for many investors. So I think the best thing to do at this moment is to be very clear around how one is assessing quality, how one is assessing the length of the growth prospects for each of the companies. A lot of themes are just being talked about. I think one needs to be very clear about these themes really showing in terms of numbers. And I think those will eventually do well is what I feel. And hence, I think the focus has to be there on quality. And in the short term, I think it's very difficult to take calls. But to me, I think these small falls will be bought into, and hence I don't see major correction unless there are some big negative events which turns out.
As a fund manager, how would you value these three pockets? Defense, railways, and power.
So the question is, how do you value, or what is the view?
Value them. Purely, fundamentally speaking, if I have to ask you a question, that how would you value these three themes? Because they are the most talked about themes right now.
Absolutely. So see, as fund houses, even we have invested into these themes. Maybe, in some of them we have got into quite early. Now, at the moment, what are we doing? At the moment, we are not selling out of these themes because we definitely understand that, these, they are supported by strong order flows. When we are talking to, let's say, the companies, the experts in the field, and we are seeing the data points, the momentum is pretty strong. Let's say defense, the order momentum is strong. Power, we know that we are at a peak power deficit. The capex needs to get accelerated. government is taking actions. There is a lot of quality improvement which is happening across discoms and all of those. So I think some of these steps and are giving you signals that they are in the right current environment today. But most importantly, one will have to recognize that the stocks have seen vertical movement upwards, and the earnings growth is not going to be vertical movement upward. Despite these order books and strong momentum, you will have quarterly volatility for these companies, which has always been the case in the past. And hence, how one deals with that through the next 3-4 years is going to be the important thing. So for us, if you ask my opinion, I think these are good sectors. We are seeing positive trends. We would like to hold on till the time that things turn adverse or data shows any adverse momentum. But at the same time, we are also cognizant of the fact that the quarterly flow of earnings may not be in sync with how the stocks have moved, and hence there could be periods of low growth or consolidation as well in these categories.
That's quite interesting that you made that point, Vinit. But the question is, about a year back, the strategy was pick up a bunch of railway stocks, bunch of power stocks, bunch of defense stocks, right? You made a basket of all of these. But do you now have to be more selective if you have to either add positions or even get in a fresh post whatever correction that plays out in these names?
No, I think a strategy to have 3-4 stocks across these themes is a right strategy, because we have seen that the volatility around a particular name could be higher depending upon the order flows, the quarterly adjustments which happens in case of these companies. So I think it is always good from diversification, from risk mitigation perspective, to have good quality 3-4 set of these companies to play the theme, and also it is going to be very difficult to maybe own a significant proportion of these companies due to liquidity not allowing that from a large size of fund perspective as well.
Okay. Do you think banks could be the new defensives now? I mean, it's something which we were discussing. Normally banks are considered to be cyclical, but could they be the new defensives for next 2 or 3 years? Valuations are okay, visibility is okay, cycle is okay, and NPAs are low.
Yeah, I mean, without labeling them as defensive or growth, I would say that bank today makes a lot of more sense, because whatever growth we are talking about in the economy, definitely it has to happen through the banking sector. And what we are talking about, this investment growth, which we are sensing through some of these sectors. My sense is that some part of that benefit will definitely accrue to the banking sector. There is a lot more fear than the real status of the banks today. The fear is that we are at a peak, names will compress. But my sense is that even if it compresses, still the banking sector as a whole, they are in the best form and shape today. There is a decent growth as far as the credit environment is concerned. The credit quality is in the best form today. So my sense is that even if the margins were to come off a bit, but I think the growth metrics would be there. The valuations are pretty reasonable, and what we talk about the economic growth, I think that should be played through the banking sector overall. Now the choice can be how one has to allocate between the banking and the non-banking financial companies. I mean, that is left to each one's individual assessment. But I think this is a good sector to own. Even from the profitability perspective, it accounts for almost 35% of the profit pool of the Nifty. So that's a large sector one can't ignore.
Vinit, there's a Goldman Sachs report yesterday which talks about cash levels with mutual funds on an average are between 4 to 5%, and that is slightly higher than historical averages. So can I safely say that even if markets they correct, then is enough and more cushion which will come from domestic investors? A, cash levels are high, B, SIPs are strong.
Yeah, so that's what I was saying, that the small falls will be actually bought into, because there is a lot of optimism, and hence we don't see a big drawdown as far as the markets are concerned, unless there are bigger events to worry about. So I think you're right, especially even in the small and mid cap categories, the valuations are expensive. We are cautious, but the cash levels also, and the cash flow into these categories also in a way indicates that the falls, the drawdowns may not be very severe, and hence and small falls will be actually bought into as I see the scenario as of now.
Vineet, the cautious stance on the capital goods sector, given the fact that we have a lot of market experts and corporates themselves as well that are betting on a strong manufacturing renaissance in India. We are seeing evidence of things picking up on ground as well. So what prompts that cautious stance?
See, the cautiousness is not about the economic recovery or the growth, which I also mentioned that we are very confident about that. We are looking at the data. The caution is more on account of the valuations, because what I'm actually seeing is that people keep talking of the same story and those stocks are getting bought into, and there is almost like a vertical, one-sided move which we have seen. And what I mentioned is that what is going to happen is that eventually the stock prices finally has to find its support in terms of the earnings growth, and in the long term, it's the earnings growth is what is going to define the percent increase in the stock price. So my sense is that as we go through these quarterly earnings, the earnings are not going to be as linear as the stock prices have seen the moves in the last few months. And hence there will be room for volatility, and that is the reason for caution, because the valuations are slightly on the high side.
Vinit, even though you believe that the small cap corrections are going to get bought into, but are there spaces within mid and small caps which are at least in the near term looking overheated to you?
Yes. I mean, overheated. There are, as I said, the same sector which we are talking, the capital goods, even consumer for that matter, considering the growth momentum has slowed and valuations have not corrected to the extent the fundamentals are actually showing up today. So if you ask me, two categories which are on the expensive side, one, the capital goods stroke capex related themes, and the other is the consumer discretionary and even non-discretionary to some extent. These are the spaces which are on the expensive side. The others like banking, insurance, healthcare, these automobile, these I feel still are on the relatively much better placed when it comes to valuations.
Would you believe that some of the new age tech companies, listed players, merit a relook? What's the general view there?
I mean, surely I think some of these new age tech companies are now talking about reduction in the losses, which is very, very important from the long-term valuation perspective. And some of them have started showing green shoots as far as the profits are concerned, and hence they definitely merit a relook. And we as a house also, we are sort of maybe looking at a couple of those names and which are still maybe under our evaluation.
Vinit, you made a very interesting point about banking, healthcare, autos and insurance being the undervalued pockets. Let's pick up one of these sectors, one by one, each of these rather. And I want to talk about banking first, because what you're seeing in banking is a stark dichotomy between what has happened in the last 1 month, what's happened in the last fortnight, and what's happened year to date, right? So, while there is a large part of these private banking, large cap names which have been underperforming, last fortnight or so, they've begun participating. So again, what's the strategy when it comes to banks? Stick it with PSBs because year to date they've performed the best? Or would you say go with the underdogs because they've just begun their move?
So our strategy has been to stay with the large private sector banks in a meaningful manner. There are some exposures we have with the PSU banks as well, the large ones. But more importantly, what we have also sort of analyzed and we are thinking is the fact that as we keep talking of peaking interest rates and interest rate at some point, starting to look down south. These banks, the NBFCs will be beneficiary of that environment, and they will see expansion in margins where the fear for banks is the margins will contract. So I think we have taken decent exposures to some of the NBFCs as well, and that's how we have been strategizing as far as the banking sector is concerned. But by and large, across our portfolios, we are almost equal weight or overweight the banking sector as of now.
So if one has to look at IT, where the world is literally divided because of disruption and because of the macros, what is the way of looking at IT now?
So See, IT, I keep talking about IT as one of the sectors which I generally have a positive bias towards because of a simple fact that this is a very strong cash generating sector. And more importantly, this is a sector which also distributes a large part of the profit back to the shareholders. And hence, from let's say dividend yield or cash flow yield perspective, this is one of the better sectors to look at. And when it comes to the balance sheet strength, I would say that if not better, they are at almost at par with how the FMCG companies' balance sheets are. So I would say this is one sector which it has a good long-term matrix also, but it will keep having these volatilities around growth. So as of now, we are in a slow growth environment, and that is also a good time to look at the sector because some of the large companies are available at decent valuations. Only point is that maybe one will have to go through 1 or 2 quarters of slow growth environment and some bit of underperformance as well. But that's the cost one has to pay if one has to be slightly early in the segment. So I think that's how we are looking at the sector.
Is happening to flows in small and mid cap stocks? We keep on getting data that large part of the flows are moving into small and mid cap stocks. It is the real reason why markets are moving higher, because if funds are coming to mutual funds or schemes, by default managers will have to invest. Is this the reality that it's compulsion which is driving some of these stocks higher?
So I would say, Nikhil, this is one of the reasons, but the other factor I would say is that if you look at one more data point, I just saw this data point that the promoters selling in 2023 has been the highest, around 80,000 crore worth of stocks is what promoters have sold, and I think versus this last year was less than half of the number. Now, what I'm also witnessing is the fact that there are a lot of these small family offices which many of these companies have started opening. So there's a lot of money which is not only coming by way of mutual funds through the small and mid cap schemes, but there are these family offices which have got set up. There are these HNIs who have become very active, looking at the last 3 years of very strong growth. So I would say there's a huge amount of capital which is chasing this category, just not the mutual fund. And when one actually, and I worry a bit because when I look at the quality of companies, now in the last 1 or 2 months in the small cap space, which have been rising, sometimes it creates, some bit of concern in my mind that, again, we are drifting down the quality chain. And whenever the turn happens, because markets are not going to be linear, and whenever the turn happens, this is going to cause a lot of pain because there will be a lot of new investors, excited investors looking at the last 2-3 years of data point and then coming up. They will be surely up for disappointment if the investment methodology is not right, if they don't pick the right companies and they go down the quality chain. I mean, that's going to be a very risky affair.
All right, it's been a pleasure having you on board. Thanks so much for giving us a lot more clarity as to what the market approach is and your preference in amidst a pretty volatile time such as this. A quick check-in as to what's going on with the Frontline index. Well, for the most part, it's laying low. It's a small cap index too that has come off from the top of the day. Names like HCL Tech, TCS, Infy are on the back foot along with HDFC Life. Britannia, Grasim, Ultratech Cement and ITC are gaining traction in trade. But let's garner further perspective, more importantly, in a market like this, how to position oneself in small and mid-cap funds, what the outlook is on the broader markets in terms of where they're headed. We've got Pankaj Murarka as well joining in on the show. Pankaj, thanks so much for taking time out. Just going by the kind of exceedingly volatile moves that we've witnessed in the broader markets from the March lows. First, we've seen a meteoric rise, and then yesterday, for instance, things were clearly shaken up. Is that an instance of the direction that the broader markets are headed in?
Yeah, morning, Aman. I think so. We've had a phenomenal rally in the last 6 months. So probably a correction was much warranted, or probably better late than never. And I think it's a healthy correction for the market because there are pockets of markets where we've seen stock prices have clearly run ahead of fundamentals, and there's been a fair degree of exuberance or froth, if I may say so, in mid-cap, small-cap space. So I think a correction is much warranted. Aggregate markets are still reasonably priced. Index, if you look at the Nifty index, trading at about 20 times current earnings, is reasonable in the context of the kind of earnings growth, strong earnings growth that we are witnessing. So I think from here on, much of the gains on the indexes are done. and markets will be more stock specific in that sense. And I think some correction at this level is pretty healthy for the medium term health of the market.
So, Pankaj, what is the opinion then on the various individual segments, right? And let's pick up what's happening in the railway and the defense names. Frenzy in the market. We've seen phenomenal returns. We were just chatting with Vineet Samre as well from DSP as to how about a year back you bought a bunch of these stocks and you're sitting on very, very handsome returns. But now looking at how frenzied these spaces are getting, the RSI levels, the growth story, etc. Do you think the best is already baked into the stock prices? And for those now feeling FOMO and wanting to catch in on the ride, would you say stay put right now is not the right time?
Absolutely. I think while the opportunities or the outlook for both defense and railway is very constructive, and both of them, to my mind, are a decadal story. So India's whole path of indigenization of our defense imports. India is the third largest spender on defense globally, and the path that India is taking, where we want to reduce our export dependence and produce more in-house or within the country, and probably become a defense exporter as well to some extent, effectively means very strong growth for companies in the sector. And likewise, railways are on their one of their biggest investment cycle, which railway has not done in their life. Their investments over the next 5 years are at about 10 trillion. 10 trillion is 3x of what they've done in the last 5 years. So I think from a opportunity perspective, sector opportunity perspective, the opportunities are very large and probably very long term. Having said that, I certainly believe from a near-term perspective, stock prices are more than pricing in the next few years fundamentals, and clearly stock prices are ahead of fundamentals in that sense from a near-term perspective. And for someone who's investing into these stocks, now, I think it's not a bad idea to take some money off the table, because stocks have moved very significantly. We've seen gains which are like 200, 300 and 400% in these kind of stocks over the last 9 to 12 months. And obviously for new investors, I understand that having the feeling of FOMO, but I would still advise them that they should hold back for a while, because it's certainly not a good idea to participate in this kind of frenzy when stocks have gone up 3x, 4x and then jumping into it. I think there'll be days where you can buy, or opportunities when you can buy these stocks at a better prices than what they are at today.
Give me an example of what is there on your radar. You said, look, I wanted to buy them, but the run-up has been too sharp. I have time. I'll wait for my entry points, but I'm clear I want to buy them. What would fall in that category? Buy on decline, but a must buy.
So we like the whole capital goods space, Nikunj. We have been significantly overweight the entire capital goods space, which includes defense and railways, because they are part of the whole investment cycle over the last 18 months. And most of these stocks have done exceedingly well. And the good thing is that after almost 10 years, we're seeing a revival in India's investment cycle, where all three segments are firing. So public investments or government investments have been strong over the last 10 years. But the good thing is, over the last few years, we have seen revival of private sector capex or investments, and we've seen revival of household investments with the revival of the real estate cycle. So let's say, for example, we have exposure to stocks like ABB, Siemens, Cummins, some of these defense names as well, including Bharat Electronics, BEML, Hindustan Aeronautics. And all of these stocks have done exceedingly well. But clearly, if you ask me, over the next 24 months, I think therefore next 24 months earnings prospects or growths are clearly priced into these, because these stocks have seen significant or massive P re-rating over the last 12 months, I would say. And now they are probably at the other extreme in terms of valuation or optimism. So while all of these stocks have probably long-term compelling growth opportunities, but I would suggest that investors should hold back and probably wait for a more appropriate or attractive price and valuation levels to get into these names.
So where do you think the pendulum has swung in favor of greed, and where do you think the pendulum is still somewhere in middle? There's nothing in the fear category, right? So I'm taking that officially away. The options are where the pendulum is in the center and where it is in the greed category. Sasta to kuch nahi, right, Pankaj bhai?
I completely agree. And see, we need to acknowledge the fact that we are in the fourth year of this bull market. It's a fairly matured bull market now. So when you're playing, meaning this bull market, to my mind, has passed its mid-cycle. So we're in a matured bull market. In a matured bull market, it's difficult to find stocks cheap on an absolute basis. What you can find cheap is on a relative basis. You find stocks cheap in early stages or early cycles of bull market, but this bull market is now fairly matured. So you're absolutely right. One has to look at value from a relative perspective. In that sense, clearly, IT and pharma clearly look the sectors where valuations are far more reasonable, because both the sectors have clearly underperformed over the last 2 years. And because of that, valuations are moderated. Good thing is headwinds in both the sectors are behind. We are seeing in healthcare or pharma, we are seeing earnings growth coming back very strongly this year onwards. So pharma companies and aggregate as a sector will deliver strong earnings growth starting this year. And likewise for the IT, I think the worst of the headwinds are behind. And from second half of this year onwards, we'll start seeing growth coming back to the sector. So clearly, from a relative basis, we find much more value in IT and pharma. And we are clearly taking money off some of these sectors which have done exceedingly well over the last, let's say, 18 months, which is essentially financials and capital goods, and putting that money to work into IT and pharma.
You've not sold Zomato, you've not sold Paytm, you've not sold Tata Motors. I just want to get it right, because these are three stocks we've discussed with you like a couple of times in the last 6 months.
Yeah, we continue to own all of them. Just that now that stocks have moved and to some extent, meaning some of those undervaluations have normalized. We're not investing more, but we continue to own. For us, these are like holdings probably which we would like to own over the next 5-10 years, and probably these are core holdings. So irrespective of the price movement, unless there's some fundamental change in the business, we are not trading these holdings.
Pankaj, since you track the IT space closely, and that's clearly being looked at as one of the defensive bets, where within IT would you buy? Would you stick with the large cap service providers, or would you look at quasi AI plays, etc.?
So we certainly like IT services company where we are invested into or buying into a combination of large caps, which is tier ones, and some of the select mid caps one where we think growth can be much higher or significantly higher than the aggregate sector growth. Smaller companies, because of smaller size, if they have right product portfolio, and these days in smaller companies, CEO change or the CEO plays a significant role. A lot of smaller companies have undergone a CEO change where they've got a new CEO who comes, who's much more dynamic and much more aggressive in driving growth. So we like those kind of stories because they're investment ideas, because there is a catalyst of changing growth trajectory of these companies over the next 3 to 5 years. So we like some of those mid-cap IT companies as well. And apart from that, when it comes to AI, I think some of these IT services companies will, in fact, actually become the biggest player on AI, because eventually every business in the world will have to implement AI tools and models. Any business who would not do that will risk their survival 10 years out. And now for that implementation, it is the same set of IT services company which will do the implementation for clients. So I think IT will become a very big growth driver for IT spends and for IT projects, and Indian IT companies will be a big beneficiary of that.
There are a lot of companies where CEOs have changed. Which are the ones you like? Because a lot of companies CEOs have changed, and a lot of companies. So what do you like within that CEO change theme?
So we like Birlasoft. They've seen a CEO change about 3 quarters back. We think the new CEO in charge is clearly very driven, and we think given the background and track record he brings with him, he can clearly change the growth velocity and growth trajectory of the company for the foreseeable future. Likewise, Tech Mahindra is undergoing a CEO change after almost 20 years. Now, for a large IT company to undergo a management change after such a long period of time, I think is not a bad idea, because companies do tend to build some flab and muscles, and you need an outsider to come and cut that. So I think it's not a bad idea in that sense. And likewise, some of other companies are also have undergone senior management change, where we are, engaging with the new management to get a better idea and perspective on the thought process of the new management before we take an investment call.
Thanks so much then for joining in and giving us your view on the markets and your advice. With news that the index is currently at 19, just at the brink of the 20K mark yet again, and seeing some sort of a pullback, we'll slip into a very quick break right here on the show. Be right back with the management of Schaeffler India. All right, let's connect then with the management of Schaeffler India. They're here to talk a little bit about the recent acquisition as well as their capex plans. Harsha Kadam is the MD and CEO joining in. Thanks so much for taking time out. Let's start off with the acquisition, the end of KRSV Innovation. What kind of revenue and margin impact do you see?
Well, at the point in time when we made the acquisition, Coors already had a turnover of about 77 crores, and we have bought the company at about 140 odd crores. And we have a clear strategy to scale this up. And as I mentioned earlier, today Coors is operating only in the south of India, and we want this to be scaled up to a pan-India level. So obviously, this can only mean an upward growth in the sales volumes.
Right. But last quarter, you did see strong performance in the auto aftermarket and industrials, which was partly offset, I guess, by the muted show in auto OEMs. Are you seeing any recovery in that segment?
If I were to look at the production and sales numbers of, let's say, the automotive OEM segment, particularly the passenger vehicles, both the sales and the production numbers for the month of August show an increase of almost 12% over the same period last year. But we have still not seen the similar kind of increases, whether it is in the two-wheeler segment or in the tractor segment. And in spite of this 12% growth in the month of August, our own Schaeffler business has continued to show a much stronger growth in the last quarter. And this is in spite of the subdued market condition in their own export businesses, because as you know, our automotive OEM export businesses were also pretty down.
Exports have been impacted due to global slowdown. What is the outlook there?
Well, exports continue to be an important part or important area for Schaeffler India. And our export growth is driven by the strong need for localization, meaning with the government's drive to be Atmanirbhar and the Make in India initiative, it is all but imperative that we make those products in India, which we were hitherto importing. Now, this also helps us to leverage the competitiveness in India to grow our export business. So there are some specific product lines we have consistently invested in, not just in the manufacturing capacities, but our own engineering capabilities as well. And this has helped us stand in good stead to become the epicenter for excellence for those products coming out of India. Now, we have significantly grown our exports over the last 3 years from a level of close to 10% of sales to around 17 to 18% last year. However, this year, we have faced some headwinds by way of slowdown in the demand due to the ongoing geopolitical situations in Europe and some economic slowdown in Europe as well. We hope the situation changes for the better as soon as possible, and we should be seeing strong numbers coming into our export business as well in the coming quarters.
And how is the traction in the EV segment? Any significant orders won within the railway space after the Vande Bharat orders?
So Schaeffler has a very strong lineage in the EV technology product line in Europe. And the aptly named the product family of drive motion, as we call it, continues to be a strategic focus area for us. And India is no exception either. So I'm pleased that we are progressing well in the electric vehicle business as well. Having secured a new business win with one of the leading electric vehicle manufacturers, we have set ourselves strongly on the path to build a robust EV technology. And not just that, but we are also now building up the competence within India to design and develop these products. our committed actions to supply the 2-in-1 e-axle or the 3-in-1 e-axle, which primarily comprises of the e-motor, the transmission gearbox, and the controller, and sometimes the thermal management modules to the Indian market, will help us to graduate up the value chain from being a component supplier to a system level supplier. Now, this will obviously add a significant value to our customers as well as to our own business. It goes without saying that we will continue to invest and grow in our foundation products, in the IC engines as well, and parallelly start to invest into the electric vehicle part production within the country. Talking about railways, railways is one of the fastest growing sector, and we are present pretty strongly in the metro trains and the passenger vehicles. We do certainly have some projects on the way to penetrate the freight trains, and in due course of time, we are optimistic that we will come out with some products for the freight trains as well.
Right. A lot of infra-related deals were announced at the G20 summit also, right? Any specific opportunity you think it opens up for your company?
First and foremost, the G20, the way it was being organized and conducted in every state, we saw a lot of buzz around it. And certainly this is putting India on the global map in terms of economic growth. There's no doubt about it. That said, now is that resulting into business? I would say this is too early and premature, but the projects that have been discussed and closed during the G20 summit obviously would benefit a lot of our own customers and thereby would cascade down as business opportunities for us. So we will definitely be watching the new needs and the new business opportunities that would surface, and we would definitely make every effort to try and leverage and capitalize on them.
Okay. Well, there is Imami. There are a lot of stocks from the mid-cap space which are off the highs. Now, I just want to establish the market, and again, it is an extension of what we saw yesterday. Large cap stocks have fallen precious little. Mid-cap stocks, they continue to see a bout of volatility. And today, the intraday graph of the Nifty is telling you that it has recovered from the day's low. But the minute you superimpose it with the small cap index or the mid-cap index or some rank mid-cap stocks, it's really the other way around where you've fallen from the day's high. Small cap stocks are off from the day's high. Mid-cap indices are off from the day's high. Railway stocks, they started up and they are not going anywhere. You want to look at PFC, REC, Adani, that's one space where bloating actually has happened. You lose some weight, become healthy enough, add some muscle, go on a diet, and I guess, things automatically will come back. It's natural progression if you ask me. You add muscle, but when you compromise on your diet, muscle converts into fat. You have to get back on the diet and then hit the treadmill, and you will soon start shedding fat and start adding muscle. So that is what markets will have to do. The excess fat.
It's all
interconnected. Just think about it. Think about what are markets. Ultimately, it is about human behavior, fear and greed. This is the most dominant theme which happens in the world. I was reading a fantastic book a couple of years ago and talks about global booms and busts. When a new sector gets created, first there is a denial, then there is excitement, then there is participation, then there is FOMO, then there is euphoria, then there is a bubble and there is a bust. I don't think it's a bubble and a bust in the mid and the small cap states, but the euphoria is where it is. So if you watch your weight right now, cut that extra fat, go on a diet before it goes bust. I think we'll be back to square one.
Before you have to be on a stringent diet.
Exactly. So I don't think they are there yet. Exactly.
Okay. On that note, we'll take a very quick break. When we come back, we'll talk about more market trends and, of course, get you corporate voices as well.
this apartment. Island kitchen.
लॉक करें?
और जब ये नया फ्लाईओवर बन जाएगा ना, मॉम एंड डैड विल बी जस्ट 20 minutes away. तो परफेक्ट नहीं है घर.
इसीलिए housing.com with maximum properties. housing.com पर से perfect.
All right, welcome back. Just a quick check-in as to how things are trending when it comes to the broader universe as well and what's moving around, given the fact that we've completely flattened out as of now. You've got names that stand out. The likes of an IOL Chemicals, for instance, is seeing a double-digit gain. Ajanta Pharma is flaring up in trade. KC International has been a buzz from the word go and currently quotes higher by nearly 6% or so. Glenmark is in the green, BEML, as well as something like an SJVN. Those are all active within the broader markets. But let's listen in to some top market voices. What is the road ahead for the equity markets? What is the strategy that you should adopt? Listen in.
Indian market, has a tremendous journey in the last few years, and it's shining very well in the global arena as an economy, as a market capitalization, and by all standards. It's something great news for India to celebrate.
All the good news are there in price. That does not mean that market is going to fall today or tomorrow. This may continue for 1 month or maybe for 2 months. But of course, it is not going to last forever. 100% it is euphoria. It is you can say that FOMO or whatever the terms we use in this market. So people are still fascinated about now penny stock and cheap stock and chota price ka stock. SME also, I think psychologically people treat that SME like a penny stock. I think so. SME is not a penny platform. Let me clarify this thing.
The country is firmly, on track to continue its growth rate, being one of the fastest growing economies in the world. And for a change, I think this milestone does not sort of scare you. I think this is a milestone which is backed by fundamentals, which is backed by optimism that this growth rate is going to continue. And therefore, I think it gives confidence that this is just one of the milestones. There are many more which we need to conquer as we move ahead. I think one has to be definitely optimistic because there is still a lot of room ahead for the economy in the markets, but extremely, extremely cautious of not getting sucked into this FOMO kind of a situation.
Once again, euphoria, which has made a comeback. So I think what I feel is that the mid caps and small caps could take a bit of a breather, and you're seeing that on the screen today with the downtake. And this could continue for some more time because there is clearly room for some downside. But I think the focus is really going to move to the large caps from here. So the large caps can make up for the underperformance of the last couple of months is what the view is for the next few weeks. And we do see the Nifty gradually moving towards a level of 20,400. I know it's not big in percentage terms, but unfortunately, I don't have large targets to work with because I do believe that the Nifty is going to be in that band of 19,500 to 20,400.
We have booked our profits in Tata Consumer and Tata Elxsi later. But in Tata Elxsi, we booked profit, very early, around 4,000 levels. Then it doubled from that level, but no regret. We have moved into Tata Communications since last 2-3 years, and we continue to hold. We don't mind a correction happening sometime by 10-15%. So even what we discussed, the Raymond. So we continue to hold.
Atul Auto has an EV story, which is going to play out, which has started playing out. Stock is expensive. Let me tell you, if you will study the balance sheet and financial numbers, does not support the current price. So I don't want to say anything else. And Weber Global, as you had named, so they are into e-commerce company. That is euphoria has cooled down, and this is what keep on happening in the market. So these story are e-commerce story. I haven't sold any shares of Weber Global because I think story is yet to play out.
I would definitely urge that this is not the time to just blindly get into something because there's a name defense or a railways or a shipbuilding or an EMS attached to it. Be discreet. There is, as I said, lot of opportunity in these sectors. I think we have been extremely positive, particularly on the steel cycle and also within steel, specialized steel. I would be in that camp which would say that in the next 6 months, banks should outperform the Nifty.
Power, I think, still has a lot of upside left. I mean, look at Tata Power, JSW Energy, CESC, and some of the smaller mid-cap names. I think there it's a more structural trend. I don't think it's got parabolic as yet. So I'm still comfortable holding on to power and buying power on dip.
Wow, for Goindia Stock joins us now. Rakesh, first, everybody is stunned with what happened yesterday in terms of the magnitude of the fall. Do you think that was in isolation, it looks ugly, but do you think that was an overbought market which was looking for a reason to correct? And unfortunately, yesterday was that day?
Yeah, I mean, it's a minor correction in the whole scheme of things.
And actually, stocks are stabilizing today, so I don't really see too much of worry. Obviously, when something is overbought, such corrections are welcome, and then only the strength of the up move can actually, the strength is much better if there are these kind of corrections during the up move.
So I'm going to now shift to your core expertise. Metal, cement, and channel checks are indicating that another round of price hike has been announced. Do you think this is largely in order to meet the inflationary pressure which has come back, or this is pricing power which is coming back?
It's neither, I would say. Basically, August has been a very lean month in terms of monsoon, and construction activity has really picked up quite dramatically. We are into a pre-election year, and I'm expecting a similar scenario for the next few months, where demand pull is going to be very strong. And prices had corrected, in the last 2-3 months, and this was the first opportunity where there's a double-digit volume growth coming in cement. So cement companies have tried to take a price hike. As of now, only in East India, prices have actually stuck, and they've taken a second price hike on 10th. Rest of the India hasn't really seen any major price upticks till now. But I think it will be a regular story every month. They will be trying to increase price till Feb March.
Cement stocks have had a. If you look at the cement sector outlook at the beginning of the year, it was quite constructive. Roads were getting built, bridges were getting constructed, government balance sheet is in good order, and everybody thought that the cement demand will surpass expectations and cement stocks will make money. And then on top of that, a consolidation happened in the sector. But that has not translated into reality in terms of numbers. Why is that?
So there are 2-3 issues which are at play here. Obviously, the expectation was that EBITDA margins for cement companies are going to increase dramatically because demand is good and cost pressures were relenting. However, the main leader in the cement space, UltraTech, has been more focused on market share gains, and that has really led to muted cement price hikes as compared to what was expected. So that is one scenario which is playing out. Number two, cement companies are already trading at a much higher valuation. So the scope for re-rating is hardly there. So it is just the earnings growth which is actually driving it. And that's why, you don't really see too much of a big up move. And third is, consolidation is happening at the periphery. It's not really a big theme, I would say. Already, top 4-5 companies hold more than 50% market share. So from here on, consolidation would be, a very slow process.
The cement sector always has been debated as a regional play. South versus North, East hardly has any capacity, and Central is where the consolidation is happening. If you have to bet on a cement space right now in terms of regional preferences, where would you lean?
So I won't really do, any kind of a regional pick because I think the cement market has changed quite a lot. And the larger companies are becoming more and more powerful. They are the ones who are setting the price. They are the ones who are growing the fastest. So it is best to stick with the large, companies who are growing at a, good pace. The valuation gap which is there between regional companies and large companies is going to stay for, for a pretty long time. So better stick with large companies only.
Where do you think cement valuations should actually line up? Because a lot, in a sense, was talked about after the 2 acquisitions which happened. Adani acquired both the companies. So what to your mind is the new normal in terms of EV per ton for the cement sector for FY25 and FY26, considering that we are in for a double-digit economic growth?
So if we are talking about smaller companies, I think they will trade at around $50-60 per ton. The companies which are, single region with capacities up to around 10 million ton. Only if they are being acquired that they will, inch towards $85-90. The larger companies are trading between $150 to $200 per ton. and that's for a reason because they are able to reinvest the capital, and they have a much better brand pull. So they do like 200 to 300 rupees per ton extra margin. So that's the range. Smaller companies, $50-$60 if they acquired around $80-$90, and larger companies 150 to 200.
Next point is about the combination of steel and cement. Cement is a local play, steel is a global play. China is a letdown for steel sector, but US is an uptick. So if you have to choose between steel and cement, what should one do?
So it's no brainer. Cement is our preferred pick for the next few months. In steel, largely it is the long product which is seeing some bit of an uptick. But what we are seeing is that China has been producing a lot of steel and they've been exporting. So steel prices haven't really been moving up in the global market, and any hint of a little bit of demand pickup is resulting in raw material prices, iron ore and coking coal moving much ahead of steel prices. So steel margins are not really improving, and I think for investors, cement is a much safer and a better play, at least for the next few months.
I'm just going to mark markets right now, and if I look at the markets right now, there is a bit of a step back in terms of the mid and the small cap stocks. That is something which off from the day's high, but no large selling in terms of where the excruciating move in the small and the mid cap setting is. Where do you think the next big re-rating will happen in the infrastructure space? Cement is unlikely to see a re-rating. Defense has already seen a re-rating. Railways has already seen a re-rating. Construction stocks are going through a phase of re-rating. What is left within the infrastructural, old economy space where the re-rating is around the corner?
When you rightly put, there's a very limited scope for re-rating for the prominent players in that space. I would think it's still better to play with some of the EPC companies are still looking very cheap. They are trading at between 6 to 9 times EV/EBITDA. Prior to 2018, they used to trade at around 15 times EV/EBITDA. So there is scope for re-rating for the EPC companies. And I think overall the banking sector is looking relatively undervalued. So that could be another play for if the capex cycle is picking up, because cap goods, cement, etc., all look fully valued in terms of at least multiples.
So great to have you on the show today. Thanks as always for taking the time out.
Thank you.
Okay, that's the view coming in on the overall market and largely the cement sector. In fact, let's revisit what the overall market has settled in at. It was a quiet start, and then again you saw the broader end of the market cooling off. So saw a little bit of a dip even for the Nifty, and then again a recovery coming in. And similar is the price action for the mid and the small caps, although they're a lot more wobbly right now. Flat. Holding around the 20,000 mark, at least for the futures. ABB, Havells, Bata, REC, these are all the names which are getting beaten down. We'll take a very quick break. When we come back, we'll have our chartist come back for Chartbusters and, of course, get you some trading ideas too.
Welcome back. Still tuned into First Trades. Let's connect with our chartists to find out their top chartbuster ideas. It's jagged edges on the Frontline index. So what is it that they're betting on? Naresh Mirani is joining right in. Naresh, what's your chartbuster call?
So that's a chart for the BSE small cap index now. That is the one which comes up on radar in terms of a correction in the last couple of sessions. Yesterday, we saw almost a 3 to 5% drop across all small caps. Now, this is a chart for the BSE small cap from 2020. And if you look at it in the previous rally in 2020 to 21, 50 DMA acted as a strong support, and this is where any retest came to it, we saw bounce back. It's only when it started breaking below those levels in 2021-22, it created a top and a sideways consolidation. Then a turn above it in 2023 in a meaningful way was the start of this rally. So if you look at those levels, that comes to 35,200, 35,500 roughly. The last bit of, say, shakeouts as well as the recent swing low comes around that area. And in that case, it would be a fall of say less than 10% from 38,700. So looks like a normal shakeout correction, which could go towards those levels or before it. But till the time we don't start breaking below that 50 DMA, it would not be a much deeper correction. So we could be either getting towards that 35,200 mark, or we get into a time-wise correction after today's dip. So overall, looks like a shakeout and a correction. One should be waiting out for some more time before to start dipping in.
Naresh, on that note, let's have your stock strategies too.
So on the short-term trading side, being more defensive, a buy on power grid, relatively low beta stock, stop loss at 184, target price of 220. A sell on trend, which has rallied a lot, showing some bit of topping out signs, stop loss at 2100, target of 1950.
Let's move on. Naresh, we'll see you again later in the day. We'll let you go on that note. Let's now welcome on board the management of Texmaco Rail and Engineering. We have with us Indrajit Mukherjee, the ED and Vice Chairman of the company, joining in on the show right now to talk about the business, about the sector, etc. as well. Mr. Mukherjee, great to have you today on ED now. Now, you're looking to consider raising funds, as we understand recently. Reports are suggesting that you're looking to raise about 500 crore rupees via QIP. Help us understand, A, what's the sum that you're looking at raising, and what kind of investors are you looking to get on board, and what is the objective really behind the fundraise?
By and large, I think we are looking at slightly more than 500 crores. So we are looking around 750 crores of fund to be raised. The second question that you had was why? This is a combination of, as you know, our production is getting ramped up at a very high speed, at a very high rate. We already have achieved almost 250% jump from what we used to do last year. And now I expect that this is going to be going up by another 75-80%. So, I mean, totally we would be around 400% jump that we are expecting in terms of both production of our freight cars, that's the railway wagons, as well as, backward integration plants like the foundry. So as a result of this, we need more working capital. We need some balancing capital equipment to support that. And last but not the least, we also would like to retire some of our debts because the debt level has gone up. So that's the object of the fundraising.
Thank you so much for highlighting that so candidly. I also wanted to talk about, this multinational rail deal linking India and the Middle Eastern countries and EU, which got announced at the G20 summit. Tell me, what kind of opportunities do you think it could bring for you at Texmaco?
I think it's opening up an endless opportunity. If you would really have studied the announcement that has been done. In fact, this has been brewing since 2021 in the G7 meeting when the US president had suggested a similar kind of an action, more or less in the way that China have done their BRI, the border roads. So he's doing their BRI. So this connects, as you know, a whole part of the Middle East. It starts from Dubai, and Mumbai to Dubai can be a ship channel, which is a short one, and then it cuts across the entire Middle East up to Israel in Haifa, and then it takes off from the Haifa port to European countries. So for us, we are represented in all the segments. Those are required, or those will be required for this stretch. We make rail freight cars of various types, and we are one of the companies who are making a global standard. We are laying railway track through our EPC company. We have done the dedicated freight corridors in India, so we are highly experienced. We also do signaling. I must correct that we have not done the entire track laying of dedicated freight corridors, but we are doing the entire signaling there. But we do freight car, the track laying elsewhere we have done. We are in the overhead electrification. So all that's required as the ingredients to connect from one part of Middle East, which is from Dubai or from Jebel Ali to Haifa, and we feel that we have a strong competencies, presence to be playing there.
I just wanted to understand from you about the overall competitive intensity, because that also is quite high. So how confident are you about getting these orders without actually compromising on your profitability?
It's too early to say, but because we really don't know how it's going to pan out. But the opportunity is going to be very large for everyone in the global companies to play, because if you really look at the distance and the type of work that is required to be done, it's going to be a huge investment. So I don't think that's going to be a major issue. I think it's the issue of how we manage ourselves to do that. And that's what we have already started thinking about and looking at it, making our tactical plan, our strategies for the same.
Okay. What is your current order backlog and what kind of revenue visibility do you have? Are there any significant orders that are in the pipeline? Can you share with us the breakup of the execution over FY24 and 25?
Well, we are sitting right now on an order book of something like about 7,000 crores, 78,000 crores in that range, and that's a lot. And orders, the market is very buoyant, as you know, and we keep on getting orders almost every month. So that's the order book position, and that's the reason why we are ramping up production. That's the reason why we are adding on to capacity, and that's the ultimate reason why we are going on for some fundraising.
Fair enough. So what about your focus in terms of orders from private players? Can you walk us through the share that you have from your private projects? And what is the margin differential between government versus private?
See, it's a difficult question because I think I should be restrained in giving any forward-looking statement. But I think we are looking at the sales turnover to go up by a substantial percentage from what we have done last year. And we see a continuous trend of growth for the next 3 to 4 years, for which we have a visibility because we have the orders. As regards the private players are concerned, we are doing a lot of private orders. In fact, the private orders could be somewhere around 20% of the total railway purchase. I mean, 20% of the total purchase of railway wagons. And we have a very substantial share there. We have a very substantial share with the major players. In addition to that, you must be aware that we also have a joint venture with a French leasing company. So that also another private player where we normally our preferred vendor will be Texmaco. So we are very strong in the private segment.
What are your plans to diversify into the non-wagon segment and the non-railway segment? How is that coming along?
We have found that tremendous business opportunities in terms of in the component business. When I say component, I would mean that there are lots of components which are required for building a wagon. So we have positioned ourselves as a company with high technology, where we have access to technology we have developed in-house, or also we are also looking at outside for the global technology. So before we move to other segments, which we have our eyes on, but that's a very competitive segment. Before we move into the other segments, we want to be excelling, and we want to be the best performing in the freight cars as well as the freight car components. And this is not restricted to India, because there is a global shortage of components. You must be, I don't know whether you're aware that we already have a joint venture with an European company, which is the second largest European wagon manufacturing company. And that one of the purposes of that joint venture is to supply them components from India, from Indian manufacturing base. Of course, that joint venture also will be making wagons, so our capacities will further go up. So that's a major focus for us now, the wagon components. We are looking at also the passenger mobility, but we want to be very selective there because we don't want to take too much risk. We want to be making money there. So that's also very much under active scanner.
You also produce around 500 wagons per month, right? Will this then cross, say, 700 to 800 wagons by the end of the year as you up your capacity?
Yeah, if our plan goes well, we should be hitting that number next month. We should be doing the same number, 750 next month. I think this month we did about 550 wagons, and it's steadily going up. It's a segment which has got a lot of challenges because there are lots of uncertainties in the whole process. Material supply, the ecosystem hasn't developed to that extent. But I think we are getting over that. That's history now.
Yeah. So how much, or rather, what is the quantum of wagons that we're looking at by the end of the year, considering you're already going to clock 700 plus by the next month?
We would be able to touch 800 wagons by the end of the year. I'm talking of per month rate. And we have a mission to go 1K, which is 1,000 in the coming financial year.
Okay. I'm sure you'll clock that as well. But you were also looking to demerge the rail EPC division, right? Where significant funds are blocked in slow-moving receivables, as we understand. What's the status on that?
We have applied we have started the procedure for demerging the EPC business, which we call the Kalindi part of the business, because that's a company which we acquired sometime in 2013-14. The reason for doing it is very simple, because we have rediscovered our core competencies in the manufacturing, and EPC requires a different management bandwidth, and we felt that would be best done if we put it as we demerge at a separate company and then try and build up. But now the story that we just now discussed a little while ago about the India, Middle East, European mega economic corridor has been announced, that's going to change a lot of the fortune of the EPC companies, and Kalindi will be definitely one of them, will play a very major role. That's the way we look at it.
Time. Good to have you on board. That's the word coming in from the management of Texmaco, a 750 crore fundraise. They are looking at an upward trend in the sales for the next 3 to 4 years and are also looking at tremendous opportunities in the component segment. Let's slip into a very short break, get you lots more news and updates when we return.